Welcome back to The Explainer. Today, we're tackling a business venture that is honestly unlike anything else on Earth. Buying a restaurant, a software company, or a manufacturing plant, those are your standard corporate acquisitions. But buying a bank? That throws you into a seriously complex and heavily regulated economic universe. To put it into perspective, the global banking system holds hundreds of trillions of dollars in assets. It is literally the bedrock of the modern economy. So we're going to look really closely at the economics of acquiring or starting a bank. We'll dissect exactly how this unique business model functions, what it costs to actually get in the game, and of course, the massive risks involved. All right, let's dive right into this.
To understand why anyone would even want to buy a bank, you first have to understand the magic trick right at the center of the industry. It's called fractional reserve banking. Unlike literally any other business, a bank is legally authorized to essentially create money out of thin air. Let's walk through the math real quick. When a customer deposits $100, the bank doesn't just lock it away in a vault. If the reserve requirement is, say, 10%, well, that means $10 stays in the vault and $90 goes straight out into the economy as a loan. And it doesn't stop there. That $90 gets deposited into another bank, which holds $9 and lends out $81, and the cycle just keeps going. This extraordinary privilege, this ability to leverage customer deposits to generate massive economic activity, is exactly what makes the banking sector so incredibly powerful, and as we'll see, exactly why it requires such immense oversight.
So, here is our roadmap for today. We'll cover how banks make money, the cost of entry, the regulatory and operating gauntlet, measuring the profit potential, major risks and bank runs, and finally, is it worth the risk?
Part 1. How banks make money.
Before you buy any asset, you really need to understand its core revenue engine, right? In banking, the fundamental unit economic metric that drives profit is called net interest margin, or NIM for short. Think of it as the bank's markup. A bank borrows money from you, the depositor, and pays you, let's say, 2% interest. It then turns around, takes your money, and lends it out for a mortgage or a business loan at 7% interest. That 5% spread, that is the net interest margin. But here's the catch. This margin is not static at all. It constantly fluctuates based on macroeconomic conditions. When the Federal Reserve raises interest rates, the cost to borrow from depositors goes up. That can rapidly squeeze this margin if the bank hasn't simultaneously adjusted its own loan rates. But if a bank can manage its NIM effectively through these economic cycles, it essentially has a license to print steady, predictable profits. Now, NIM is incredibly important, but it's just the largest slice of the pie. A modern, well-run bank actually supplements its primary lending margin with two other crucial revenue streams. First up is fee-based income. This is everything from monthly account maintenance fees and overdraft charges to wire transfer fees. But more importantly, it includes wealth management advisory fees. This specific type of income is highly prized by bank owners because it offers really high margins and carries absolutely zero credit risk. You'll love to see that. The final revenue slice is investment income. Banks invest their excess capital into safe, liquid assets like government treasury bonds, just to earn a return on funds that aren't currently deployed as active loans. Together, these three streams create a really robust, diversified revenue engine. Let's move to part 2, the cost of entry. Okay, so we know how the machine works, but what does it actually cost to get the keys? Well, the financial barriers preventing everyday investors from entering the banking space are monumental. You can't exactly bootstrap a bank in your garage. Regulators demand massive upfront capital requirements just to ensure the bank can absorb potential early losses and protect depositors' funds. If you want to start a brand new bank, you are typically looking at a requirement of $15 to $30 million in highly liquid capital. And that money, it just sits there, completely idle, before you even open your doors or write your first loan. Now, what if you want to skip the startup phase and just buy an existing bank? You're looking at steep acquisition premiums. Buyers often pay 1.5 to 2 times the bank's actual book value just to acquire that established deposit base. So you generally have two paths to entry: starting a new bank, known in the industry as a de novo bank, or buying an existing one. Starting a de novo bank means you get a total clean slate, no legacy bad loans, and you get to use modern technology right from day one. But it is a grueling timeline. It usually takes 18 to 24 months of bleeding cash on legal and consulting fees before you are legally allowed to open. Plus, you have to organically build a customer base from absolute zero. On the flip side, buying an existing bank gives you immediate scale, an established brand, and cash flow on day one. However, alongside that heavy acquisition premium we talked about, you risk finding a skeleton in the closet. You might inherit hidden bad loans that are just about to default, or an incredibly messy, outdated technology infrastructure that will cost millions to untangle. Bottom line, neither path is cheap.
Section 3, the regulatory and operating gauntlet. Because banks have this unique power to create money and manage the public's life savings, they operate within an incredibly heavy bureaucratic reality. The regulatory approval process is painstakingly strict. First, as we just discussed, you have to raise that massive pile of capital. Then, you apply for either a state or federal bank charter, which basically dictates who your primary regulators are going to be. Step 3 is securing FDIC deposit insurance. Let's be real, without the FDIC backing your deposits, no consumer in their right mind would trust you with their money. Finally, you pass the rigorous regulatory approval hurdles. Regulators will scrutinize your business plan and your financial projections, sure, but most intensely, they vet the people. They will pull decades of tax returns and dig into past litigation for every single executive and board member you plan to hire. It is intense.
And once you finally get the green light, the operating expenses are relentless. We aren't just talking about paying tellers at a branch. You need highly specialized staff, expert credit analysts, risk managers, and literally an army of intensive compliance professionals dedicated solely to making sure you're adhering to thousands of pages of banking laws. Then there's the tech. Banks run on what are known as core banking systems. These are massive, notoriously expensive software engines that handle billions of data points securely. You need ultra-secure, redundant infrastructure to prevent cyber attacks and ensure 24/7 uptime. All of this heavy overhead eats directly into your bottom line every single day, regardless of how many loans you write.
Which brings us to Section 4, measuring the profit potential.
With all these staggering costs and regulatory burdens, how do investors actually determine if a bank is a worthwhile investment? In banking, we primarily look at two critical benchmarks: return on assets, or ROA, and return on equity, or ROE. Let's break the math down because this is where the business model truly shines. A healthy bank might have an ROA of just 1%. Now, in a vacuum, a 1% return sounds pretty terrible, especially compared to a high-growth tech company. But remember, a bank's assets are mostly the loans it makes using other people's money. Imagine a bank has $10 in shareholder equity and $90 in customer deposits. It lends out that total $100 as assets. A 1% return on that $100 is $1 of profit. But that $1 of profit compared to the owner's original $10 in equity, that is a 10% return on equity. Leverage is absolutely the key to driving massive shareholder returns in banking.
Section 5, major risks in bank runs.
But leverage is a double-edged sword, right? A bank fundamentally manages two major types of risk, and one is significantly deadlier than the other. First, you have credit risk. This is the traditional fear that borrowers will default and fail to repay their loans. Credit risk usually causes a slow deterioration of the bank's health as bad loans pile up over months or even years, which at least gives management some time to react. On the other side, we have interest rate and liquidity risk. This is sudden, and it is the true bank killer. This happens when the value of a bank's safe assets drops due to shifting interest rates, right at the exact moment that depositors panic and demand their cash back immediately. If the ball doesn't have the liquid cash to pay depositors on the spot, it dies. Period. The timeline of the Silicon Valley Bank collapse is basically a textbook modern case study of how this liquidity risk plays out. Step 1, the broader economy saw rapidly rising interest rates. Step 2, because SVB had invested heavily in long-term bonds back when rates were low, those new higher rates caused the value of their bond portfolio to absolutely plummet, leaving them with massive unrealized losses. Step 3, word got out, sparking total depositor panic. And in the age of social media and mobile banking, panic spreads in minutes, not days. Step 4, a fatal bank run. To put the severity into perspective, depositors initiated withdrawals of $42 billion in a single day. That was a quarter of the bank's total deposits. SVB couldn't liquidate their devalued bonds fast enough to cover the withdrawals, and the bank collapsed instantly. It's a terrifying reminder that no bank can survive a modern digital run.
Finally, Section 6, is it worth the risk?
So with the crushing regulations, the tens of millions in upfront costs, and the terrifying reality that a digital bank run can literally wipe you out in 24 hours, why do investors still pursue this asset class? Well, it comes down to three incredibly powerful reasons. First, access to fractional reserve leverage. There is simply no other legal business model that allows you to safely leverage capital at a 10-to-1 ratio to generate returns. Second, the diverse income streams from the net interest margin and fee-based services create a highly stable, cash-flowing machine when managed properly. And finally, the economic moat. Those massive regulatory hurdles and compliance gauntlets that make it so incredibly painful to start a bank, they actually act as a gigantic wall keeping your competition out. Once you are established on the inside, you are operating in a highly protected, elite industry.
We've laid out the entire business case for you today. You've seen the incredible economic power of leveraging customer deposits to essentially create money. But you've also seen the massive capital required, the relentless compliance gauntlet you have to run, and the existential overnight risk of a fatal bank run. It's a business of pure extremes, immense financial privilege beautifully balanced by immense vulnerability. So I'll leave you with this final thought. Having seen the full picture, the true costs, and the absolute power behind the curtain, do you still want to buy a bank? Thanks so much for joining me for this explainer, and I'll catch you on the next one.